Hey, what's up, guys? Hope you're doing well. James here from Forsythe.com, and going on a bit about more about shadow banking and things like that. So we're going to start off with credit intermediation, and we're just going to head straight off into the screen share for a article that was written, or not an article, but it was an actual paper written by Zoltan Pozar years ago. And then before I forget, make this bigger so you guys can see it better, hopefully. But anyway, so kind of understanding like what before we get into shadow banking, like what exactly is banking in general, and so that kind of gets into the whole idea of credit intermediation, right? And so the whole point of a bank, to a certain degree, is like you put your savings or whatever funds into the bank, right? And then they lend it out. So that's not entirely how it works, like not directly. It's not literally like they take your money and that's the same money they get out. There's more into it, but we're just kind of making the concept there. They kind of use that as a way, right? Um, Without getting into the nuances of it. So basically, it's instead of direct lending to where you're lending directly to someone for them to buy a house or whatever, maybe you're doing it through a bank instead. So you're using them as an intermediary for that lending transaction, right? And so that really kind of helps from the saver's perspective, the ones who's actually using their funds, right? So when you put your savings and stuff into a bank, because that basically brings about the economies of scale, right? Because you don't have to sit there and screen, monitor, um, find out the credit worthiness of borrowers, things like that. The banks doing that themselves, and so on, right? And say you don't have hundreds of thousands of dollars to just lend to someone for or whatever. They can basically take your 5 grand or whatever it is and put it together with more and go from there, right? This a That's kind of like a dumbed down version of the lending process, right? And so, or well, credit intermediation, right? And so, with that being said, there's kind of three different transformations that comes along with that. So you have credit maturity and liquidity. And so, basically, like credit transformation refers to basically enhancing the credit quality of some kind of debt that's issued by some intermediary, right? And this is done through the use of priority claims. Like whenever you hear, like with say corporate debt, like the difference between senior and junior kind of issues, that's what we're getting at. There's kind of one that gets paid off first, and then there's another one that gets paid off after that, and so on. Right? It's kind of a ladder of who gets paid first, right? And then you have maturity transformation to where it's basically turning short-term deposits into long-term loans, and so you're transforming the maturity, the time or duration of a loan or some form of money instrument into something longer. And I'm sure you can go the opposite way as well if you wish. Um, they do, but anyway. And then there's liquidity transformation, which refers to basically making illiquid assets more liquid. And so this is kind of where you get into the kind of like an example would be mortgage-backed securities, where you're taking a bunch of illiquid kind of mortgages, packaging them into a security to where they're basically a money market instrument that's more short term and so on. You're making it much more liquid, to where it can be used as collateral for loans and stuff like that, right? So that being said, credit intermediation is frequently enhanced through the use of third-party liquidity and credit guarantees. This is generally in the form of liquidity or credit put options. And so this is the kind of insurance or backstopping in a way that you're going to be hearing a lot through this discussion of shadow banking, right? Not just this video, the whole playlist and everything else, right? And so when these guarantees are provided by the public sector, credit intermediation is said to be officially enhanced, right? And so you're going to see is there's a lot of government backstopping in this stuff, right? And so that's where we're going to kind of get into 4 different sections, or like how to, I guess, categorize this kind of liabilities in a way. So it's a liability is directly enhanced or has a direct official enhancement. It must reside on the financial institution's balance sheet, while off-balance sheet liabilities of financial institutions are indirectly enhanced by the public sector. right? It's kind of because the public sector, the government is backstopping the actual institution itself. And so you have the on balance sheet stuff to where it's like everyone knows it's there, or at least the people who read the balance sheet, I guess. Um, and that has an official enhancement, meaning the government officially knows about it. They're like, hey, basically putting a put option on this in a way, more or less. And then the off balance sheet stuff is kind of tucked in the corner and it's kind of implicit or indirectly enhanced, right, by the public sector. And then you have activities with direct and implicit official enhancement include debt issued or guaranteed by government sponsored entities, GSEs. So this is like Fannie Mae and Freddie Mac as examples. And this is one these are ones that which benefit from the implicit credit put of the taxpayer, right? So basically the taxpayers pay whenever they go bust in a way. Then you have indirect official enhancement, which generally includes the off balance sheet activities of depository institutions like commercial banks and things like that have um, reserve accounts at the Fed. And so, and this is mostly for things like unfunded credit card loans and like other credit lines and stuff like that. And then you also have indirect and implicit official enhancement to where it's kind of the off balance sheet stuff and it's implicit. So this is like asset management activities, um, bank affiliated hedge funds, money market mutual funds, security lending, stuff like that, right? Um, and that's where you kind of get into the definition of shadow banking itself. And so they actually, for this paper, define shadow bank credit intermediation to include all credit intermediation activities that are implicitly enhanced, indirectly enhanced, or unenhanced by official guarantees being the public sector, right? And then in the footnotes, given like the different kind of insurance in a way of and backstopping for different types of things like depository institutions, see FDIC, you got insurance companies, the stuff that they have, pensions with the PBGC, and so on, right? So if you want to reference that further, go ahead. And he gives a decent graphic, and see if I can. A lot of these for the graphics, it's like the print's so small you have to zoom in, but then you can't see the whole thing. So just so you can see a kind of general, make it bigger. So you got the institutions, and then have direct public enhancement, indirect enhancement, and then unenhanced, right? And then you have different categories where they split it between explicit and implicit. And then basically they say as you increase to the right of the chart, you're increasing the kind of shadow aspect of the actual activity, right? And so you just kind of keep going until you get to unenhanced, where you're seeing things like securities lending, um, and other things too. Just as examples, I'm obviously not going to read the whole thing, but that's what it's here for reference. But another thing I found pretty interesting was the size of this stuff, like the actual size of the shadow banking itself, right? So they break it up into gross and net, oh, right? And so gross is kind of everything like they could find, and then they basically tried to they call it net, like net shadow liability. So this is like so bank liabilities are liabilities of say a commercial bank, so like your deposits and things like that. Um, and it's the same idea, but for the shadow banking system, where you have the blue line is in general, like total that they've counted, and then the red line is net, which is basically where they were kind of trying to factor out double counting where they could. And one thing we'll notice as we continue to study this stuff is that there's not a bunch of, I'm going to say, very good data on it. From my understanding, a lot of it's like there's questionable, like, why isn't this counted? Or like, where can we even find this? Or it's just not even recorded at all, right? And so the gross measure for these is the sum of all the liabilities recorded in the flow of funds, which is the Federal Reserve Board's flow of funds, which I believe is the Z1 is what it's called. Um, and this and all of them that relate to securitization activities, so like MBSs, ABSs, and other like GSC liabilities, so mortgage-backed securities, asset-backed securities, and other government-sponsored enterprises liabilities, right? So Fannie Mae and Freddie Mac are examples of these. And so, as well as short-term money market transactions that are not backstopped by deposit insurance, which includes repos, commercial paper, and other money market mutual fund liabilities. So that's what we mean by shadow bank liabilities in general. And you can see that it hit a peak at around, we'll say, 21, 22 trillion. Um, yeah, trillion in late 2007 to 2008, and then it kind of goes down. And that's one thing it seems to me is really the crux of the paper, and multiple papers about this kind of topic is 2000. The whole GFC was mostly a break in the shadow banking system more than anything else, not necessarily the subprime lending. That was more of a symptom of the problem in a way. Not the people not paying their mortgages, but like the actual part of how it's implemented in the banking system in general, right? Um, which I'll get more explicit when I bring data up and can show you charts and things like that. Um, we should point out that these measures of the shadow banking system are imperfect for several reasons. First, the flow of funds does not cover the transactions for all shadow banking entities, kind of what I was talking about with actually recording data. Second, we are not providing a measure of the net supply of credit of shadow banks to the real economy. It's just kind of the liabilities that are on the flow of funds. And then third, many of the securitized assets are held on the balance sheets of traditional depository and insurance institutions or supported off their balance sheets through backup liquidity and credit derivative or reinsurance contracts, right? And so that's a factor as well, right? And so this is where we're getting into, I was talking a little bit about in the actual chart itself, where you can see the gross measure of shadow bank liabilities was almost 22 trillion in June of 22. Oh wow, 2007. Been doing a lot of data in the 2020s, so it's for some reason I just keep wanting to say that. But you can also plot the total traditional banking liabilities by comparison or for comparison, um, which were around 14 trillion about the same time. And so the size of the shadow banking system has contracted substantially since 2007, which we can see here as it goes from 22 trillion all the way down to 15, which is like what a 30 or 40% decline somewhere in there with some decimals and stuff. And this is where we have this green line here is the actual bank liabilities, which we can see in 2007, 2008 when it uptakes. It's right around here, so 13, 14 trillion ish, and so that's rather big difference, so to speak. So I think that's yeah. And so these governmental liquidity facilities. So basically, this is where we were talking about the put options, like for the public enhancement in a way. So like basically, the government has these liquidity facilities to where they're going to provide liquidity when the shadow banking system cannot, right? Because this is really where you have to have um, money needs to be able to flow because this is where you have a lot of funding for things that you it's the funding for pretty much everything from my understanding for the most part. Where I'm going with this, I don't think this is the right chart. Maybe it's later in there. I had a thought halfway through, which we'll get into later. Later, we'll get into like the actual steps throughout the process of how they kind of function, how these entities function, and what's the how they do stuff, and you have to pay attention to where they get their funding for each individual step. So as you can see, you have like bonds, commercial paper, different asset-backed securities. You have CDOs, and it's like a different one for almost every step. And so you have to keep that in mind when you're doing these or thinking through these. And so basically, if any one of those steps comes in, this is where the government liquidity facilities that I'm talking about comes in and kind of fills that gap. If the shadow making system can't maintain it on its own, right? And so most of these were introduced since the summer of 2007, and it had helped ease the $5 trillion contraction in the size of the shadow banking system. thereby protecting the broader economy from the dangers of a collapse in the supply of credit as the financial crisis unfolded, right? Because this is really where credit comes from for like banks and things like that. So, like whenever you go to a bank and get a mortgage, odds are they're basically flipping that mortgage to Fannie or Freddie, and then kind of they package it into a security, and then that's used as kind of a as an MBS in the shadow banking system in a way. So stop screen share because that's how I'm breaking up this one. So I'm gonna leave that there. I guess big takeaways is shadow banking is there's a lot that goes into it, and so it's really kind of understanding where this credit intermediation comes in through like I guess non-traditional finance in a way. I'm not sure if that's a great way to describe it. Um, but you have to pay attention to like where this kind of enhancement is coming from. Like, is it direct or indirect from the public sector, or is it kind of like is it explicit, like say like the FDIC, or is it implicit to where it's like there's not like anything written about it, but they're kind of going to do it anyway for other reasons. Maybe it's like maybe it's implicit, or maybe something is implicitly enhanced or basically protected from the public sector because, say, you have um, a bank have something off balance sheet, and if that off balance sheet asset or enterprise or whatever goes down, that bank has to help it out and basically prevent it from collapsing. And then the government comes in and helps the bank, right? Kind of along those lines, right? So, anyways, I'm going to leave that there. So, I hope you guys have a good night, and I will see you on the next.